So welcome back everyone, this is Mayank Kothari. This is going to be another lecture where we are going to learn lots of concepts, and we are going to start with the H model concept first. Okay. Now what is this H model? H model is another way of calculating the market price, present value of the market price, just like we saw it in 6 stage, 5 stage, then 2 stage dividend discount models. But there was some problem in the two-stage or multi-stage dividend discount model. What was the problem? I will tell you. It was all okay till the time we saw that question where the growth rate was linearly declining, like every year 1% or 2% or like that. But before that, we saw some questions where the growth rate was like this. Let me just draw a table. We will write it as H model. Okay. So I was about to draw the graph. Let's say this is years, this is growth. 1, 2, 3, 4, 5, 6, 7, 8 and so on. Then 5, 10, 15, 20%. Okay, so let's say for example the growth rate is 15% right now, and it goes on for 15% itself for 5 years. But then the question says that after this growth, the growth will stabilize to 5% from 6th year onwards till perpetuity. Now there is a problem in such scenario. We call it as a practical problem. Practically, it is not possible that in the 5th year, the growth rate in the dividend was 15%, and immediately after that, in the 6th year, it came down to 5%. So there is a sharp decline in the growth rate in that small period of 1 year, which is not practically possible. There has to be linear, or we can say stage-wise declination, or we can say decrease in the growth rate. So it should have been like 15 to 13, 13 to let's say 11, 11 to 9, 9 to 7, 7, then 5. So over a period of 3-4 years, the growth rate should have reached 5 instead immediately. And that is where the H model comes into picture. H model actually, through its new formula, actually decreases the growth rate linearly, stage wise, and put that impact in the market price, which solves the problem of immediate or instantaneous declination on the growth or decrease in the growth. So this is going to be the H model now. So what is the formula in H model? Let's say the formula. Market price is equal to, we have to learn this formula, D0 in bracket 1 plus GN divided by cost of equity minus GN. Now what is this GN? GN is nothing but normal growth rate, or we can say stable growth rate, which is 5% in this scenario. Okay, but there is a second part to this equation, D0 H1 in bracket K GC minus GN divided by KE minus GN. So if you will see, the denominator is same in both the cases. The denominator is same in both the cases, and in the numerator there is one thing called as H1. H1 or H is nothing but half of high growth period. So in our case, the high growth period was for 5 years. If you can clearly see 5 years, half of that is 2.5. That is what you are going to take it here. Then what is GC? GC is the current growth rate, or we can say initial growth rate, or we will say high growth rate. That is 15% in the scenario that we have seen. So in this question, in this entire equation, there are two growth rates, GC and GN. GC means the high growth rate, GN means the normal growth rate, which was 5%. Sir, why they have used the word C and N? They could have easily said that GH for high growth rate. It is easy to remember, right? You can do so for your own understanding and nobody is going to stop you. These are the variables used in the institute's formula. That's why I have taken it like that. But please understand, instead of mugging up the formula, if you remember what exactly should be taken here, the logic, then there is no need to remember the variables. You can just understand that the first phase, first part of the H model, you can just remember that thing. The first part of the H model says uses the stable growth rate or perpetual growth rate. So you use GS or GN or GP, anything, it will be all right. Okay, and in the denominator in both the equation you will see it is GN only. So normal growth rate, stable growth rate, perpetual growth rate, one and the same thing. Okay, so this is the formula that we are going to use. We are going to see one question on that, and I'm going to prove that this formula is right, but I will prove it after solving this question. So let's first focus on the question. Question number 38. Have a look. I will just remove all this. So there is one company called as Lockheed Martin. Lockheed Martin, the aerospace and defense conglomerate, has a stellar dividend history. All the story has been given in this and we will pick only the things that are required to us. So it has a stellar dividend history with steadily increasing quarterly payments since 1995. They have been given good returns, good dividends. And in the recent year, the rate of dividend growth has declined from a solid 15.6% in 2014 to 10% in 2016. Okay, so you can see 14, 15, 16. Of course, the 2016 fiscal year has just begun as of this writing, but the total dividend can be extrapolated from the first quarter dividend of $1.65 per share and the company's history of consistent quarterly payments. This entire statement in this question is not relevant. You can just write it for your next understanding, means the revision. Okay, we'll just move ahead. Based on the steady rate of decline, and underline the word steady rate of decline. So that 15.6 to 10% was not immediate, was not sharp decline. It was a steady rate of decline. It can be assumed that dividend growth will again decrease by 2.8%. Again means it was already decreasing by 2.8%. If you can see, 2014, 15 and 16, just write it down, or I can write it down in full numbers. It was 15.6%. If you reduce 2.8 from that, you will come down to 12.8, and then again reduce 2.8 from that, you will come down to 10%. And then the question is saying that again it is going to reduce by 2.8 in 2017, and the growth rate will be 7.2%, and after that it will be stable perpetually. So in this question, our GN will be 7.2 and GC or high growth rate will be 15.6%. Okay, then now exactly what we have to calculate. Okay, this example will use LMT's actual dividend performance for 2013 to 2016 along with a projected decline and stabilization in 2017 to produce a value estimate for the stock in 2013 using the H model dividend discount calculation. So this entire statement has a meaning and I'm going to explain that to you. Don't worry about it. Let's say this is the timeline. 2014, 15, 16, 17 and then perpetual. So 2014, 15, 16, 17, 13. This is 13. So the growth rate was 15.6%, 12.8%, 10%, 7.2%, and then 7.2% perpetually. Okay. What else? Question is saying that you will have to calculate the market price at the end of year 2013, and for that purpose you are going to use these decreasing growth rates and the stable growth rate as well, and the past dividend. See, they are saying here as they are going to use the actual dividend performance for 2013 through 16 with a projected decline and stabilization. All the three things, dividend, high growth and stable growth, will be used to produce a calculation or a value estimate of the stock in 2013 using this model. For the purpose of this example, we can take cost of equity as 10%. 10% expected rate of return will be used. The number of year over which the growth rate will transition is 4. So our H1 will be 4 by 2, half of the high growth period. Calculate the value estimate using 2013 dividend payment of $4.60. So what was D0? D0 is $4.60. And see the transition phase. High growth was from 15.6. So we are going to start from this point. 15.6% was the highest growth rate, started from this point, not this point. It started from this point. So for 1 year, 2 year, 3 year, then again decreased at 4 years. So for the 4 year, the growth rate was this much, and then we are going to take half of that. So how we are going to calculate the market price? Have a look. According to H model, answer. D0 in bracket 1 plus Gn divided by cost of equity minus Gn plus D0 H1 in bracket Gc minus Gn divided by cost of equity minus Gn. Have a look. 4.60 was your last dividend. 1.072 is the stable growth rate divided by 10% cost of equity, 0.072 your stable growth rate, 4.60 into half of the transition period, that is 2 years, 4 by 2. 15.6% was the high growth rate minus 0.072 stable growth rate. Okay, then let's solve it. Now rest of the part is just the calculation. It comes down to 176.11 plus 27.6, and the total is 203.71. This is the market price according to H model. It's very simple to calculate. But still you might be in a confusion, sir. How come this should be the price? And I'm going to prove it with the help of normal calculation that we have been doing till this point. If this question would not have been like H model, we would have solved it in a normal way. And in that scenario, how we would have calculated the market price? Sir, it's very simple. We would have calculated D1, D2, D3. And we can clearly see after D3 the growth rate is same. So we can stop our calculation here by calculating MP3. Okay. So just taking the present value of these 4 was our market price, and it should be this much. If I prove that present value of those 4 cash flows is somewhere near to this or this exactly, then that means this model is also right, because this model has been working for us since lots of questions. And if the answer according to this and this is same, then the model is right. Have a look. let's calculate it here. Year, cash flow, present value factor at 10% and present value. So let's calculate for first year. The first year the dividend will be 4.6 into 1.156. Am I right? 15.6%. 5.32. Second year it will be 5.32 into 1.128. 12.8%. 6 rupees. On third year it will be 6 into 1.10, that is 6.60. On fourth, so no, not required. On third again we are going to calculate the MP3. So have a look on this. MP3 is calculated based on D4 and D4 is calculated as D3 in bracket 1 plus growth. Am I right? D3 is nothing but 6.60 into 1.072. The growth rate in the fourth year is 7.2%, right? Do the calculation. It comes down to 252.69. So let's just write it here. 252.69. These are the three cash flows, the 3 years dividend and the third year's market price. Now take the present value factor according to 10%. On the calculator, 1 divided by 1.1 equals to 0.909826751 and 751. Am I right? Let's do it. 5.32 into 0.909 m plus 6 into 0.826 m plus then 6.6 into 0.751 again 4.96. 252.69 into 0.751 189.77. MRC 204.52. See, only 1 rupees or we can say 70 paisas difference is there from that answer to this answer, and we can most of that difference is the part of is because of the rounding off, because every point at here we rounded off the figures here also and here also. So 70 paisa is considerable difference. We should not give it much importance. So we can clearly say that approximately both the answers are correct. And this was the way we used to calculate the market price. And if this answer and this answer is almost matching, then the H model is also right. It is not just something formula we have to put it and then the answer will be there and we have to accept it. No, it's not like that. Okay. So this was all about the H model. We should not focus more on that. One thing that I would like you to note down is in the compiler itself, please make sure you put marking what is GN, what is H and what is GC. Do it immediately. GN is nothing but normal growth rate. You can say stable growth rate or perpetual growth rate. Write down all the names, not just one. H is the half of high growth period. And GC is nothing but current growth rate, initial growth rate or high growth rate. Write it down immediately. Because next time you will be revising this entire compiler, you should know what are the formulas and what does GC, H and GN means, because other things are like we know all those things. So let's move on to the next concept, which is IRR, internal rate of return. I'm going to explain a couple of things about it. Let's start. Have a look. And before we learn about this concept of IRR, we have to learn about another concept called as interpolation. It seems a little bit concept, but yeah. Interpolation, have a look. I will just draw few things. So 1, 1, 2, 3, 4, 5, 6, 7, 8, 9. Let's draw it one more time. 10. What do you think this is? These are the stairs, steps on the stairs. And let's say, for example, there is one guy and he has rupees 20 with him, and he looks at the stairs and he sees that there are some currency notes lying on the steps of this floor, the stairs. He goes to the first step, he picks up the note, he sees that the second step also has some currency note. He just goes up and then picks up that note as well. And this way, if he keep going and keep picking up every currency note on every step, then he will have the total of 100 rupees with him when he will reach at 10th step. So the two situations have been given to you. If the guy is at 0th step, total 20 rupees is there in his hand, and if he reaches to 10th step, there will be a total of 100 rupees in his hand. My question to you is, can we find out how much rupees this guy will have if he reaches to 4th steps and does the total of whatever is there in his hand? Yes sir, we can do this calculation very easily, because we can clearly see that on the 0th step he has 20 rupees, and if he reaches to 10th step, he will have 100 rupees. So in total, for the 10 steps, for going up 10 steps, he has added 80 rupees to his wealth. So practically speaking, if nothing else is given, we will assume equal amount of money were kept on each step. Okay. So what was that total amount? 80 rupees for going up the 10 steps. Okay. Now, if we want to find out how much he will have at the end of the 4th step, we are going to first find out how much was kept at every step. So it is very easy. 80 rupees in total for 10 steps. That means for every step it was 80 divided by 10. That is 8 rupees. So he was picking up 8 rupees at every step. Okay. So I think for 4 steps he would have added 8 into 4, 34 rupees to his wealth. 34 plus 20, that is 54 is the final answer. How did we calculate? We did it like this. At 0th step he had 20 rupees. At 10th step he has 100 rupees. Right. So by going up 10 steps, the difference between two, he added 80 rupees, the difference between two. He had added 80 rupees to his wealth, and the wealth started from 20 rupees. Okay. But we wanted to find out how much he will have at the end of the 4 steps. That means the total difference from 0 to 4 is, you have to cover only 4 steps, and then you will have to find out the answer. So this is how it goes. We will start from 20, right? And we will write down like this. 80 rupees is added to the wealth if we move ahead 10 steps. But if we move ahead only 4 steps, how much will be added? So it is like this, divided by and then multiplication. Please make sure the base of this is 20 rupees. The base of this is 20 rupees. Then the base of the numerator should also be in rupees. So 20 is rupees, 80 is rupees, 10 is in steps, 4 is in steps. So the common base should be like this. One is in the numerator, the other one is in the denominator. But this base should also be in the numerator. So 20 plus 80 by 10. 80 by 10 will give you something like this. 20 rupees plus 8 rupees into 4. What is 8 rupees? 8 rupees is there for every step that you move ahead. So 8 into 4 goes to 34. So how much you have added to your wealth? 34 rupees. And the total is 54. This entire process is called as interpolation. It means that if at this position we have 20 rupees and at that position we have 100 rupees, that means the difference is 80 rupees. Difference between the rupees and difference between the steps. 80 rupees for 10 steps, 8 rupees for each step, and for 4 steps 8 into 4, 34. This is the process of interpolation, and that is what you are going to find out in this IRR method. So this was all about the interpolation. Now let's talk about IRR. Let's see. Let's say for example that you invest 100 rupees in a particular share and you get 110 rupees at the end of the year by selling that share. Okay, 100 rupees of today's 100 rupees cannot be compared with tomorrow's 110, right? So in order to do the comparison, we will have to discount this 110 rupees. Let's say the discounting rate or our required rate of return is 10%. If 10% is the rate of return, you will do 110 divided by 1.1 to discount it, and it will give you the figure like this, 100. So 110 is the cash inflow, 100 will also be the cash inflow. This is nothing but the present value of future cash flows. So what we are going to write, this is present value of cash inflow. This was present value of cash outflow because we wanted to buy the share. And if we do the total of both present value of cash inflow plus present value of cash outflow, it will give us NPV, which comes to 0. Present value of cash inflow minus present value of cash outflow. So 100 minus 100 is NPV, which is 0. What does this mean? Does this explains the fact that we did not earn anything? No, sir. We did not earn more than this rate of return. 0 means, or whatever the figure means, this is the amount that we have earned more than this return. And if we want to find out exact return of earning, NPV should always be 0 at a particular rate. Let's change the question a little. I will write it down here. Now understand, we are changing few things. Let's make it 8%. At that time we will divide it by 1.08, and 110 divided by 1.08 gives us 101.85. okay, and the NPV will be 1.85. What does this NPV means? NPV doesn't mean 1.85 is our earning. It means this is our extra earnings in addition to 8%. So we have earned more than 8%. Are you getting it? We have earned more than 8%. How much exactly we have earned can only be obtained by bringing NPV to 0. So we can say that this much we have earned more than 10%. This is 0. That means we have earned 10%, right? Here, this much we have earned more than 8%. That means we have actually earned more than 8%. In order to calculate the exact rate of return, we have to bring down this NPV to 0. And if we want to bring down the NPV, then we will have to raise the discounting rate. Why? I will tell you. Just have a look here. When you do 1.1 divided by 1.10 means when you calculate the present value factor with 10% discount rate, it goes to 0.909. Calculate it with 1.09 and you will get 0.917. Do it with 1.05 and you will get 0.952. Now you can clearly see that as the rate of discounting 10, 9, 5% is decreasing, the values are increasing 909, 917, 952. Reverse will also be true. If we want to reduce the values, increase the number. So if we want to decrease present value, discount rate should be increased. If we want to increase present value, discount rate should be decreased. This is true. Now come over to this. We want to bring NPV from 1.85 to 0, means we want to decrease present value, hence increase the rate of return. Okay, let's do it one more time. What we are going to do? We are going to increase the rate of return. Now let's say the rate of return changes from 8% to something else. Let's make it 12%. I don't know. We just found that we have to increase the rate, but how much will not be given. This is called as trial and error method. You are just trying out your luck. 12%. At that time you will do 1.12. 110 divided by 1.12 means you are discounting the cash flows at 12%. It will give you 98.21 and the answer will be 1.79. Okay. Now, and that too negative because 100 was the higher figure. 1.79 negative. Now understand that you did not want NPV to be negative. You wanted NPV to go to 0. From negative to 0, we have to increase the NPV. And in order to increase the NPV, we will have to decrease the rate. Okay. Now you can clearly see that the NPV of 0 lies in between these two NPVs. Between 1.85 and 1.79. Have a look. It is 1.79, 0 and 1.85. So our desired NPV, which is 0, lies in between these two NPVs, and 1.85 was the NPV at 8% discount rate. 1.79 negative is at 10% discount rate. That means a particular rate of return where NPV is 0 lies in between these two. Because 0 also lies in between these two, the discount rate that we want also lies in between these two. Now we have to do the interpolation on this data. Have a look how to do that. It's very simple, sir. At 8%, we will say that the NPV is 1.85 and at 12% the NPV is minus 1.79. Getting it? So by moving ahead 4%, we are actually decreasing the NPV by 3.64 rupees. First we are going back 1.85 rupees, then again we are going back 1.79 rupees from 8 to 12. But we wanted the NPV to decrease to 0 only. So we wanted to go back how many steps? 1.85 steps only. 1.85 steps only. So we'll go it that way. 4 divided by 3.64 into 1.85. See, from where we are starting from 8%. So our actual rate, base rate is 8%. Then we say that when we are increasing the discount rate by 4%, the decrease in the value is 3.64. Or we can also say that NPV decreases by 3.64 when we increase the rate by 4%. And if we have to decrease the value only by 1.85 rupees, then how much will be the increase in the rate? So in total it will be like this. 2.03, that goes to 10.03, approximately equal to 10%. 10.03. Are you getting it? This is called as interpolation. This is the rate 10% at which the NPV becomes 0, and that is what we wanted. But we did it through two different rates. So the first rate is that you have to assume, and after that looking at the answer, we will have to decide whether we have to increase the rate or decrease. We wanted to decrease the value, we increase the rate. And then we found that somewhere in between these two rates, our desired value is there, and hence we interpolated these figures. The same thing we are going to do in question number 39. Have a look on this question now. What do you mean by IRR? IRR is the rate of return where NPV becomes 0. Okay, one more thing. I will just keep it here. IRR is a rate of return where NPV becomes 0, or you can say present value of cash inflow is equal to present value of cash outflow, because when both are equal, NPV is automatically 0. In this question of Piyush Lunkar, we have a cash outflow at rupees 20 while purchasing the share, and that's why we need to find out a rate of return where the inflows are also equal to 20. Only then the NPV will be 0 and we will call it as IRR. Okay, have a look on this question. First part is very easy. Piyush Lunkar and Associates presently pays a dividend of rupees 1. Underline the word presently pays. We will call it as D0 per share and has a share price of rupees 20. Okay. Calculate the firm's expected or required return on equity. Underline it and write down KE. Using a dividend discount model approach, if this dividend were expected to grow at a rate of 12% per annum, put a box around forever. Forever means perpetual. And if that is the case, it is very easy to find out the cost of equity. I will tell you how. See, question number 39, first part. What do they want us to find out is the cost of equity. Forever formula is this, na? MP0 is equal to D1 divided by cost of equity minus growth, which is also equal to D0 in bracket 1 plus growth divided by cost of equity minus growth, right? And the price is 20 rupees. So 20 rupees is equal to, have a look, 1 rupees of the, how much is the dividend? 1 rupee. Growth rate is 12%. The growth rate is 12%, right? Okay. The growth rate is 12%. Then cost of equity is what we don't know. And 0.12. Solve it. K is equal to 1.12 divided by 20 plus 0.12. K is equal to 17.6%. Was that difficult? No, sir. 17.6% is what you are earning in this if the market price is 20. That is cool enough. Okay. 20 was nothing but the cash outflow while buying the share, MP0, and dividend is nothing but cash inflow. So this question ultimately gives you 20 outflow, 20 inflow at 17.6%. And at that time, we will say that we are earning 17.6% in this investment. Now comes the second part, which is the most important part of this question. Calculate the firm's expected or required return on equity. Again, they want us to calculate the same thing, that is cost of equity. If instead of this situation in part 1, that means forget about the 12% growth rate, forget about the forever thing from the beginning. Suppose that the dividends were to grow at a rate of 20% per annum for the first 5 years only, and then 10% per year thereafter, and now calculate the cost of equity. They have changed the situation. This was a pure question of perpetuity, but this is a question of two-stage dividend discount model, where the first stage is of 5 years and then the perpetuity is starting. In this part, the perpetuity was starting from the very beginning. In this part, the perpetuity is starting from 6th year onwards. And now we have to calculate the cost of equity. So have a look. 1, 2, 3, 4, 5 and perpetuity. D1, 2, 3, 4, 5. Okay. And then MP5. How to calculate the market price? Market price is calculated when we discount all the future cash flows. Is this right? This is how we have been solving the question since long. Okay. But in this question, we do not want to calculate MP0. In fact, this is already given to us, which is 20 rupees. We can calculate all the dividends as well. See, 1 rupees in the beginning and then add 20% for all the 5 years. We can calculate MP5 also. But one figure is missing, which is cost of equity, and that is what you have to calculate, that at a particular rate, at which rate the present value of cash inflow become outflow. See, when you buy the share, it will be your present value of cash outflow. And all these 5 figures are your inflows. Let's say, for example, you will sell the share at the end of 5th year. You will get that MP5 and the dividend of 5 years also. So all those are inflows. When you discount it, it will become present value of cash inflow, and it should be 20. When the inflow is 20, outflow is 20, the cost of capital that you used to do this is called as IRR, internal rate of return. So we have to find out a particular rate of discounting where the present value of all the future cash flow comes down to this. Okay, let's do that. Year cash flows. So first year, second year, third year, fourth year, fifth year, and fifth year. First year, 1 rupees dividend into 20% growth gives you 1 rupees 20 paisa. Then 1.20 into 1.20 will give you 1.44. 1.44 into 1.20 will give you 1.73. 1.73 into 1.20 will give you 2.08. And 2.08 into 1.20 will give you 2.5. Or we can say 49. Let it be. Fifth year, all depends upon MP5. MP5 is nothing but D6 by cost of equity minus growth. D6 is nothing but D5 in bracket cost of equity minus growth. Sorry, D5 in bracket 1 plus growth divided by cost of equity minus growth. D5 is 2.50. Growth rate is 10%. After 5th year, it is 10%. Divided by minus 0.10. The only figure is cost of equity. See, till this point, it's very easy. Now is the question, what should be the cost of equity? So let's assume, this is called as trial and error method. So we have to assume from our own calculation of the question. In the previous part, the cost of equity was 17 point something percent. What we can do is we can just take that rate, 17%, let's say. Let's take it 17%. 1 divided by 1.17, 0.855, 0.731, 0.624, 0.534, and 0.456. This will also be 0.456. Since you have taken cost of equity as 17%, put it here and find out the value. It gives us 39.29. Let's find out the present value. 1.03. 1.44 into 0.731, 1.05. 1.08, 1.11, 1.14, last 17.92. Total. So it is giving us 23.33. So it is giving us a little higher value. We wanted this present value to be 20 only. So whatever rate we have taken, we know from this point onwards that we have to decrease the present value from 23.33 to 20%. And you know what? If we want to decrease the value, we will have to increase the rate. How much? See, 23.33 and 20 has very little, we can say, gap or distance between these two. So the next rate that you are going to increase should also have a small gap or little difference bit from 17%. So instead of taking 18%, let's take 19% and repeat the entire question. That is what the cumbersome process in this IRR method is. We have to do everything again and just changing the rate by just changing the rate. So I'm just removing all these things. Okay, and this one also and this one also. This much you have to write again in exam. Let's take 19% here. 0.840, 0.706, 0.593, 0.499, 0.419 and 0.419. Because we have taken 19%, let's find out the market price. 2.50 into 1.10 market price divided by 0.09, so it will come to 30.55. Let's find out the value now. 1.20 into 0.84, 1.04, 1.05. It has a good sequence of 1.01, 2, 3, 4, 5, and this is 12.80. If you will compare now, it goes to 17.95. See, but we wanted this present value to be 20. Now we can clearly see that our target present value, which is 20 rupees, is somewhere in between this and this. That means our required return answer is also somewhere between 19 and 17%. Okay, so let's do the interpolation. This was the first method, first step, trial and error. Then second step. Understand, at 17% you have 23.33 and at 19% you have 17.95. So by increasing 2%, you are going down in present value by around 5.38 rupees. But you want to go down till 20 only. That means you have to decrease the price. You want to decrease the price by 3.33 rupees only. Then what will be the increment in the rate? So let's start from 17. This is the basic. Very simple. This divided by this multiplied by this. So plus 2% is what we get into an increment when we decrease the price by 5 rupees 38 paisa. But when we will decrease the price only by 3 rupees 33 paisa, how much will be the increment? $1.24. So somewhere around 18.24% is your answer. If you discount the cash flows at this rate, 18.24%, your NPV will be very close to 20. I cannot say exactly 20, but very close to 20. All these answers are approximate. Whenever you do the interpolation, the answer that is arrived are approximate and never exactly correct. Means you can say perfect. It's the correct answer, you will get the marks, but it's not perfect. answer, or it will not give you exact 20 rupees. Okay, so let's go to what institute has done. See, first they took 18% and they found out that the market price is 20.23. They did the same thing. They assumed, see the word here, they assumed cost of equity as 18%. Rest of all these things are not required exactly, because this is what I have already explained to you. So they took 18%. They found that 20.23 is the market price. That means from this point we have to decrease the market price by 23 paisa. If we want to decrease the market price, we will have to increase the discounting rate, but we are very close to our target. That means the increment should not be higher. So that's why in the next page they increased from 18 to 19% only, and at 19% they found that the market price is 17.89, and then started the interpolation process. This is the interpolation process. At 18% they started. 2.34 is the amount of the price is decreasing for 1% increment. So how much will be the increment if the price is only 23 paisa reduced? Their answer is 18.10, our answer is 18.24. Both the answers are correct. Why the answers are differing, I will tell you. The two rates that have been that has been taken by this answer is 17 and 19. The difference between this, sorry, 17 and 18, no, 18 and 19, the difference between these two rates is only 1%. Okay, the two rates that has been taken by us was 17 and 19, and the difference between the two was 2%. Higher the difference in the two rates that you are taking, higher will be the chances of error. So please make sure, always keep the difference between the two rates minimum to minimum. 1% and 2% are absolutely okay, 3% is okay, 4% is okay, but 5%, 6 and 7% of the difference, if you will say I will take 10% and 20% as the two rates, no, this is not right. The distance between these two is very big. You need to cut it short to minimum possible. So this was all about the internal rate of return. I hope you understood the concept. This was the basic concept in CA intermediate. However, it is not that much important in CA final, and no more questions are there in this chapter. But yes, the interpolation concept will be used in derivatives chapter, mostly in Black and Scholes model, and at couple of times maybe IRR concept will be used, because it is an important part, and I think in international financial management maybe they can use it, I don't know. Okay, so let's go ahead and have a look on the another concept. So the next concept will be free cash flow to equity and free cash flows to firm. These concepts have been are just starting in this chapter, but large number of questions on these concepts are covered in the chapter corporate valuation and not in this. So we will just find couple of questions on these concepts. Obviously we are going to discuss the concepts in detail in this chapter itself, but we are going to do the same in corporate valuation as well, because at that time these two concepts will be used in large number of questions. So for now it's bye bye from my side. I will just take a break and I will be back with the new concept. See you. So hello everyone, welcome back. And now we are going to discuss about the next concept, which is free cash flows to equity and free cash flows to firm. E in the end means equity, F in the end means firm. Now what is exactly all these things? We are going to look after one by one. Okay, so if you will go through your charts that you have received, you will see in the security valuation chapter we have seen lots of formulas, all the formulas of dividend based model, the earning based model also, and this one is pending by now. Now this is cash flow based equity valuation methods, in which we are going to discuss about the FCFE and FCFF. So these are some formulas which I am going to explain to you. Okay, but before that, let me write down few things. Just have a look on this. So let's say this is a balance sheet in T format. What happens in that is, let's say this is fixed asset side, this is current asset side. If you remember something, this is current liabilities, okay. And above that, I'm going to write down some sources of equities, or some sources of capital, not equity, capital. So one of the sources is equity share. Do you agree? Okay. One of the source of capital is equity. Another one is preference share. And then we can say debt, then loan, etc. Okay, let me increase the space so that we can write everything that is required. Okay. And this is current liability, this is current assets, and everything. This is called as balance sheet. Am I right? Okay. There is one more thing, an important statement for the company, which is called as trading profit and loss account. Right? In vertical format, I'm going to write down, this is sales. Sales minus, let's say, operating cost. Then you arrive at EBI TDA. Why EBI TDA? Earning before interest, tax, depreciation, and amortization. So I'm making sure that operating cash costs has been considered here only, in cash only. So all the expenses which are incurred in cash has been taken there, but there are some expenses which are of a non-cash nature. They all those expenses I'm considering here, depreciation or amortization. In short, I want to say non-cash operating expenses. Okay. So after deducting the non-cash operating expenses, we arrive at EBIT, earning before interest and tax. So when you say EBIT, it means all the operational related expenses, operations related expenses has been deducted. And now the time to deduct interest. It can be from debt or loan. Okay. The moment you pay interest at this point, you are no more liable to the debt holders and loan holders except for the principal repayment, if any. Okay. This will give you EBT, and then we will deduct tax out of it. We will pay the tax, and then we will arrive at EAT. This earning after tax is used to make two types of payment. First, preference dividend. Preference dividend is paid out of this earning after tax, and after that the profit which is balance is called as EAT for equity shareholders. This is the earning after tax for equity. So the one that we calculated before, earning after tax, it was for preference and equity shareholders both. Now this one is only for equity shareholders, out of which you are going to pay equity dividend. Am I right? And then the balance amount is called as retained earnings. Okay, so these are the two important document for a company. Okay, let's first talk about the free cash flows to equity. Why we want to calculate it? We want to find out what is the amount of cash that can be distributed. Please understand, amount of cash that can be distributed to the equity shareholder without any charge. It means that first we will pay everyone else's amount, and we will also retain the amount which is required for the capital expenditure or any kind of company's requirement, and we will reach at a point where the balance amount or the balance cash left can only be distributed to the equity shareholder if the company wants so. So basically we are going to calculate the valuation of the share based on such an amount which is left for the equity shareholder. Okay. The purpose here is to calculate free cash flows to equity. So focus on that. First of all, it should be a cash flow only for the equity shareholders, means no one else, no other capital contributor like preference share, debt holders, and loan holders should be able to claim anything out of this. And when do you think they will not be able to claim anything on the amount? When they will get their own amount, they will get their own dues. So every year when you make some profit, there is some liability towards the financial expenses. Preference shareholders demand preference dividend, isn't it? Debt holders demand interest. Loan holders also demand, loan holders means loan lenders, we can say, demand interest. Apart from that, there maybe I am not saying, there may be principal repayment. So sometimes what happens is that instead of paying only interest, we give them EMI, which includes both interest and principal repayment. That's what I'm writing there. Because I have written interest separately, that's why I'm writing principal repayment again. Just a second. Principal repayment. These people can also demand principal repayment. So I think other than these costs, there is nothing else that these people will demand. And once we pay these things, the balance left will be only for the equity, and equity holders demand only equity dividend. So we have to find out a cash flow before paying equity dividend, which will be applicable to the equity shareholder. First of all, E. Now, look at this figure. Earning after tax for equity. Do you think the debt holders or the lenders or the preference shareholders have any right on this? No, sir. So can we say that this is the cash flow for equity shareholder? No, sir. This is not the cash flow. This is earnings. This is just a profit. This has not been yet converted into cash flow. So this is not applicable. We want free cash flows to equity, not the profit to equity. So focus on that. You need to convert the profit to cash flows. Now, how to convert the profit or earnings to cash flows? You will have to add back. Understand? You will have to add back non-cash expenses. Because non-cash expenses are such an item which reduces the profit but not the cash flow, which in reality reduces the profit but not the cash flow. So if you have already deducted the non-cash expenses from the profit, add it back to arrive at cash flows. Why to deduct at the first place when we have to add it at the end? Because we get the tax benefit on that. See, understand, this is why I have taken this particular figure separately. We have first deducted depreciation and amortization, which is non-cash in nature, which is reducing the earnings but not the cash. Okay, so we deducted it first, then we arrived at EBT, and then we deducted tax. So the tax has been applied on the reduced earning, isn't it? So we are getting the tax benefit on that, which is in the form of cash. Tax benefit is not a non-cash item, na? It's a cash item. So that's why after reaching at EAT, this EAT, we can add back the depreciation and amortization in order to arrive at the cash flows after tax. This is till now, this is earnings after tax. You can add back depreciation, amortization, or any non-cash item if it is deducted. If it is added, then you will have to deduct it. The only purpose of adding and deducting the non-cash while calculating cash flows, non-cash items are to take the tax benefit or tax liability. After that, we will just reverse that item so as to come to a particular figure of cash flow, right figure of cash flow. Okay, so this is it. Okay, let's do one thing, sir. Let's do one thing. As you said, we will just add that depreciation and amortization back to them, their own figures. So instead of taking any other figure, I am just referring a particular chart that I have given to you in the charts, because this is what is going to clear everything. Okay, let's take the figures of 1000. 1000 cost is 700. I will just write it down here. 1000 cost is 700, which will give you EBITDA of 300, and I can say other expenses are also 40. So 700 is the cost, this is gross profit, other expenses 40. What I will do is I will write down, instead of 700, 740. So this will give us 260, right? Then EBITDA is 260. Depreciation and amortization, let's say 50. We are left with 210 lakhs. Interest is 60. Tax is 75. Interest is 60. Tax is, and the balance amount is 150. Tax is 50%. Let's say it is 50% for the sake of simplicity. 75. Is there any preference dividend? There is no preference dividend in this part, so I am also keeping it 0. If there is anything in the question, you should deduct it. Then the balance left is 75. Okay, and I'm not taking the equity dividend right now. I just want EAT for equity. Now, sir, you said that if we add earning after tax, if we add non-cash items which were reduced earlier to earning after tax, we will reach at cash flows. Yes, sir. So can I say that cash flows after tax is equal to EAT plus depreciation or amortization, or likewise? So yes, sir. So 75 plus 50. 50 is the depreciation and amortization. So 75 plus 50 is, I think, 125. Am I right? So this is called as cash flows after tax. Can I say now that 125 is the free cash flows to equity? No, sir. You can call it cash flows to equity, but it is still not free. Now we are coming over to the first letter. We started from E, then I explained about CF, and now is the time for the meaning of F, the free cash flows to equity. What do you mean by free cash flows to equity? I can call it cash flows to equity but not free cash flows to equity. Why? What is the difference between CFE and FCFE? See, these are the cash flows to equity, but they are still not free because we have to incur some cash expenses, or we can say capital expenditure. It's not an expense, but it's a balance sheet item. It's not an expense or income to consider in the profit and loss account, but there can be something which affects the bank account, which is debit to the bank or credit to the bank, which makes cash outflow of the company, or which makes cash inflow in the company. But that is only that is purely a balance sheet item. At that time, this will not be shown in the profit and loss account. So till now we have adjusted the profit and loss account but not the balance sheet. Now understand, let's say for example in a particular year you are purchasing some fixed assets for cash. What will be the entry? Sir, entry will be fixed asset debit to bank account. Let's say I will just take the figure from here so that our entire answer matches with the figure also. So the capital expenditure taken here is, I think, 20. Okay. So let's say you purchase 20 lakhs of fixed assets in a particular year. What is the entry for that? Fixed assets are debit to bank account. Both the entries are going only in the balance sheet, but the cash is getting affected. Who is going to pay the cash for this fixed assets? This 125 will pay it. So the 125 is a cash flow to equity, but it is still not free because there are some cash expenses, or we can say cash outflows or inflows, which are yet to be considered, which is not yet considered in the profit and loss account, which is not to be considered in the profit and loss account, but it has to be taken from the balance sheet. So capital expenditure is one of the part. So we will deduct the capex item. Okay, this is done. In case we are selling some fixed asset, then we will add in cash. Okay, let's say for example we have sold some fixed assets, bank debit to fixed asset for so and so rupees. At that time we can clearly see the cash is coming into the company. We will add that item. So sale of fixed assets. However, you will not see this particular treatment in the coming question. Most of the time and almost all the time in our question compiler, capex or capital expenditure is there. That means we are purchasing some assets, not selling it. So even though such is the thing in the entire question, but don't make a habit of always deducting any capital part or fixed assets part. If it is a outflow or purchase of the asset, deduct it because the cash is going out. If you are selling the fixed assets for cash, then the cash is coming in. So that's why you are going to add that cash flow to 125. Okay. That is the first item. We are done with it. And the rest of the item is this. This is called as working capital, current assets minus current liabilities. Now, if you are purchasing some stock, let's say for example, if you purchase some stock, so what will be the entry? The stock account debit to bank. What does that mean? That means the current assets are increasing if you are debiting the stock. And please do not consider these current assets and current liabilities in total. I can say non-cash current assets and non-cash current liabilities. Why I'm saying this? Because if I take the bank account also, which is included in the current asset, then the balance will be zero. The balance will be zero. I need to find out the cash flow now. So I need to keep the bank account from the debit and the credit side if there is an overdraft and so on. I have to keep the bank related accounts out of this current assets and current liabilities working. Okay, so that's why I'm writing non-cash current assets and non-cash current liabilities. So for example, if the stock is being debited, so what is the treatment which is going into non-cash current assets? It is increasing. So whatever is the amount, let's say 5 lakh is the amount. By 5 lakh, the current assets are increasing. And if the current assets are increasing, the working capital will also increase. I am going to give you an example for that. Don't worry about it. Let's say for example, current assets excluding bank account, we call it as non-cash current assets, is 10 lakhs. Okay. And current liabilities is 4 lakhs right now. So can I clearly say that the working capital, the non-cash working capital, non-cash is 6 lakhs. Now if you are adding the stock for let's say 5 lakhs, so what will happen? The current asset will become 15 lakhs. 15 minus 4, that is 11 lakhs. So can I say that the working capital has also increased by 5 if the current asset is increasing by 5? So there is an increase in the working capital when we are paying or when we are spending money, because in order to purchase the stock we have given out, there is a cash outflow from the company for 5 lakhs. Stock debit to bank, na? So bank is being credited, cash is going out of the company. If the current assets are increasing, working capital is also increasing and the cash is going out. So we will put a negative sign here. Negative means deduct. That is cash outflow. Can I say that? So we will deduct it ultimately. if the current liabilities, for example, if the current liability is decreasing, let's say another example, I will just remove all these things. Let's say, for example, you have paid creditors worth 2 lakh. So what will happen? The entry will be creditors debit to bank. Again, the cash is going out, and 10 minus 2 will be the balance in the current liabilities if you have paid 2 lakhs. And you can see that the working capital is still increasing if the current liability is decreasing. So if the current liability is decreasing, working capital will still increase. It will still be the cash outflow, and we will still deduct it from the cash flows. Another entry. If the current assets are decreasing, that means working capital will also decrease. Directly proportional, indirectly proportional. That will be called as cash inflow. Let's say, for example, what is the example of decrease in the current assets? I will tell you. Let's say you have debtors worth 5 lakhs in the current assets, and now they have paid all the money. So once they pay all the money, the entry will be bank account debit to debtors. That means the current assets will get reduced by 5 lakh rupees. The balance is 1. So bank is being debited. So that will be considered as cash inflow. We will add it. If the current liabilities are increasing, we can say the working capital will decrease, opposite or indirect treatment. It will be cash outflow. Inflow. Current liabilities are increasing. Cash in, and then we will add it. So this is it. Most of the time, I can now conclude something from this. If there is an increase in the working capital, deduct it because it shows cash outflow. If there is a decrease in the working capital, add it because it shows cash inflow. Are you okay with this? Most of the time it will be increase in the working capital, and we will deduct it. After adjusting this non-cash working capital and the changes in fixed assets, I think we complete everything. Interest, principal repayment. Principal repayment is also something. We have paid preference dividend, interest also. So one more thing is left, which is called as principal repayment. Deducted. Also one more thing is there. If you are issuing new debt, issue of, add because cash is coming in. New long-term debt. See, any issue of short-term debt will be covered in the working capital change, not in the long-term. These are the long-term part. If you are issuing some funds, it will be covered there. So new long-term funds. Then we will add it. So after making adjustment of capex, sale of fixed assets, increase in working capital, principal repayment, issue of new long-term funds to 125, we will arrive at FCFE. Now you can clearly see how only cash flow to equity has become FCFE now. In order to free it from everything, we will still have to adjust the balance sheet item in that 125. Till 125, we have adjusted only the profit and loss item. Okay. Profit and loss item to convert the earning after tax to cash flow after tax. But that is not enough. In order to convert the cash flows after tax to free cash flows to equity, we will have to adjust all the balance sheet items which are affecting the bank account. So if there is an outflow, we will reduce it. If there is an inflow, we will add it. Increase in working capital is outflow, reduce it. Decrease in working capital is inflow, add it. Principal repayment is outflow, reduce it. Issue of new long-term funds is an inflow, add it. So accordingly, we are going to give the treatment. The logic is the balance sheet has to be adjusted here. If there is an inflow, add it. If there is a outflow, deduct it. This is the logic, and this is how FCFE is considered. Okay, coming over to this point, have a look. Sales, cost, gross profit, other expenses, EBIT, DA, depreciation 50, EBIT 210, interest financial expenses 60, EBT 150. See, now I will just take one by one and I will explain that to you. Now understand that when you start from this point, sales minus cost, you reach at 260, then you deduct 50, then you reach at EBIT. Now if you will see earning before interest and tax 210 lakhs is an amount out of which every capital contributor is demanding their own money. Lenders are demanding their interest, debt holders are demanding their interest, preference shareholders are demanding their preference shares, preference dividend, and equity shareholder is also equity demanding their equity dividend. Okay, so this is the amount out of which everyone is demanding their dues. Okay, but on the next step, when you pay the interest to debt holders and lenders, now their demand to the extent of interest is being reduced, is being eliminated. Now they cannot demand their interest. They cannot demand their interest out of 150. Am I right? This 150. They were eligible to demand their dues or interest out of 210, but they cannot demand their interest out of 150. Out of 150, we will pay the tax to the government. Out of 75, we will pay the preference dividend. The moment we pay the preference dividend, preference shareholders cannot demand anything. Okay. Now we reach at equity after tax. Earning after tax for equity. Now tell me one thing. Out of this 75, do you really think preference shareholders can demand any income? No. Debt holders can demand any income? No. Lenders can demand any income? No. They cannot demand any income. But still, debt holders and lenders can demand their principal repayment. This is not an income for them, but still they can demand it because company promised them that every year along with interest they will also pay some principal, and that's why it is 75 cannot be used for equity. Okay, 75 is earning. First of all, we converted this 75 of earning to cash flows, so it has become 125. Now out of 125, for example, out of 125 you have adjusted everything in the profit and loss account, and let's say for example you make the payment of principal repayment also. So this one also, out of 125, if you make the payment of principal repayment, now no one out of preference shareholder, debt holders or lenders can demand anything. So this cash flow is purely cash flow to equity, but still it is not free. Why it is not free? Because still there are some capital expenditure and increase or decrease in working capital which is yet to be adjusted from the bank account. So once you adjust the capital expenditure and increase in the capital working capital, the balance left will be called as free cash flow, and that is for equity because no one else can demand anything from that amount. After 75 itself, no one can demand any income, and after deducting the principal repayment and issue of new long-term debt, no one can demand anything including the principal repayment. Getting it? Basically speaking, you have to calculate such an amount which is a cash flow to equity holders and also free from any other charge. Getting it? So you have to first deduct every possible cash expense, cash income. You will have to add cash income, add back non-cash items, make the payments for other lenders, and then the balance left will be called as free cash flow to equity. This is pretty simple. Calculating free cash flow to equity is pretty simple because you are deducting every cash outflow and adding every cash inflow. Okay. The more difficult part is to calculate free cash flows to firm. Now this is going to be an interesting part. First of all, let's find out what is the formula for free cash flow to equity. Free cash flow to equity is net income. That means the profit after tax, or we can say earning after tax for equity shareholders. So once you reach at this point, this income is already of equity. That means you have deducted the preference dividend out of it. You have deducted the interest also out of it. Now balance statement has to be given. we are adding back we are adding back depreciation. So once we add depreciation in the earnings, it becomes cash flow after tax, and still this amount is not useful for the equity shareholders because balance sheet is not yet adjusted. So the next item is adjust the fixed assets, deduct the capital expenditure, deduct the increase. See this red button, or we can say the red icon which is going up, it means increase in non-cash working capital should be deducted, and if it is decrease, then we will add if the decrease is there. Okay. And then if there is new debt issued, please in your chart itself write down new long term debt issued. If there is new long term debt issued, add it back, because short term debt will be included in the working capital, and if it is not included in the working capital, then you will have to again write one more item there plus new short term debt issued. Okay. And then if there is debt repayment, or we can say principal repayment, write down principal repayment minus, sorry, if there is an outflow you will deduct it. After all these adjustments, you can clearly see all these are balance sheet related items. Fixed asset debit to bank account, then current assets debit to bank account, or bank account debit, or we can say current liabilities debit to bank account. Then this is adding the cash, adding means the cash inflow, bank account debit to debt holders, and this is outflow again, debt, or we can say debenture debit or loan account debit to bank account. So basically these are the items, all items related to the balance sheet only. Once you adjust all these things, you will reach at free cash flows to equity. Okay, I will just stop it here because the discussion can go on and on and on. Okay, now we are going to find out how to calculate the free cash flows to firm. This is going to be an interesting part. Free cash flows to firm. I will just remove this certain parts. I think it is not possible. I will just prefer to write it down again. Have a look. Fixed assets, current liabilities, and here I will write down equity, preference shares, debt holders, or simply writing it as debt. Then loan. Okay, what is exactly that we give all is equity shareholder demand equity dividend, preference shareholders demand preference dividend, debt holders demand interests, one second, interest and principal, loan lenders also demand interest and principal repayment. Okay, now calculating FCFE, was only from the angle of equity shareholder. But if you want to calculate FCFF, you have to calculate the cash flows from which these guys, all of them, equity, preference, debt, loan, are yet to receive a single amount, a single penny. That means an income, please understand, an income converted into cash flows before paying any interest, principal, preference dividend, or equity dividend. Rest of the things will be adjusted. That means capex will still be deducted. Yes, sir. Increase in working capital will still be deducted. Yes, sir. These are the two normal items. But you will have to take an earning and convert it into cash flow and take the earning before paying any of these items. So again, have a look. Sales, cost, EBI, TDA, depreciation and amortization, EBIT, interest, EBT, tax, EAT, preference dividend. So EAT for equity shareholders, equity dividend, then retained earnings. Am I right? I will tell you one thing. We started FCFE like this. In order to calculate the cash flows for equity, we started from the earnings for equity. Now, if you will look at this thing, profit and loss account, this is earning, this is also earning, this is earning, this is earning, this is earning. Now tell me one thing, which earning did you start with? Obviously, if we are calculating the cash flows for equity, we will start with an earning which is also applicable for equity, and that is this figure. Am I right? Earning after tax for equity. Okay. So you have a clarity that it started from EAT plus EAT for equity. After that, what we did? The second thing that we did was we converted this earning into cash flows by adding back depreciation or amortization. That is non-cash item. Am I right? The moment we added this back, we found that we have completed all the adjustments for profit and loss, and now is the time for adjustment for balance sheet. Then we deducted the capex, increase in capital expenditure, or we can say change in fixed assets. We will deducted capex. Then we deducted increase in working capital. Okay. If there is any additional funds that has been issued, we added that. And if there is any principal repayment, we deducted that. This was the formula. Okay, cool. Now tell me one thing. If we start calculating for free cash flows to firm, the firm itself means such a cash flow which is applicable for all the 4 capital contributors. So we will start with an earning which is applicable for all of them. Now tell me one thing. Do you think this earning is applicable now? This earning should be taken? No, sir, because preference shareholders, debt holders and lenders have no right on earning after tax for equity. Do you think this earning after tax should be taken? This earning after tax cannot be taken either, because I will tell you why. This earning after tax, let me start again. This earning after tax can only be claimed by equity shareholder. This earning after tax will be claimed by equity and preference shareholders, or I will just write it in short words, letters. It's in fact, this will be claimed by equity plus preference shareholders for their earning, because equity dividend and preference dividend is yet to be paid out of this. But debt holders and lenders cannot claim anything out of EAT. So this is also not applicable. Again, going above, can you take this? No, sir. EBT is claimed by equity shareholders, preference shareholders and government, because government also demands their tax. Can we take EBIT? EBIT is claimed by, first of all, debt holders, then lenders, then government, then equity holders, then preference shareholders. So yes, sir, this is the income which satisfies all the capital contributors. So EBIT can be taken, but there is one problem with the EBIT. Government also gets included in that. We want only 4 people or 4 types of person, or whatever the fund contributors are there in your example. These 4 should only be able to claim on that and no one else. So what we will have to do with the EBIT, we can clearly see that one of the demand is being satisfied here, that all the 4 capital contributors, that means debt holders, lenders, equity shareholders and preference shareholders, can claim this earning, but along with them, government is also claiming their earning in this. So what we are going to do, we are going to start with EBIT, no doubt about that, but we will deduct tax out of it. So just put 1 minus tax so that the government gets their own money. Okay. Done with the thing. Now this is the earning. EBIT 1 minus tax, where government cannot claim anything because you have paid them their dues. Now this is the earning which will be claimed still by the equity shareholders, preference shareholders, lenders, and the debt holders. Okay. After that, it is the usual process: depreciation and amortization, add back, capex, deduct, increase in working capital, deduct. Will you take this? No. Will you take this? No. No principal repayment or long-term new funds should be shown here, because we want to calculate the funds for cash flows for firm, and firm includes debt holders and loan holders. So any of the payment should not be deducted. No payment out of this should be deducted or added. So principal repayment cannot be deducted if we are calculating the firm's cash flow. See, will you say this? If you will add, let's say for example, the new funds added are 20 lakh rupees, and what you are going to do with this is you will add 20 lakhs rupees. What will this mean? This means that the debt holders contributed 20 lakh rupees, and now you have increased their free cash flows to firm, and you are saying that your free cash flow to firm is 100 instead of 80. This doesn't make sense, because you are putting money in your own pocket, and then you are saying that we have 100 rupees of the cash flow. See, for example, I will tell you. You are calculating the cash flow for me, right? If you are calculating the cash flow for me, will you consider this transaction? Let's say for example 10 rupees. Adding or deducting any principal repayment or long-term new funds, addition of the new funds, doesn't make sense in FCFF, because it will be just like taking out money from my one pocket and putting it in another pocket. Because you are calculating for myself, like I am calculating the cash flows for myself, and I cannot consider any amount that I have given to the company or I have taken from the company. Before doing all these things, I will have to find out what is the cash flows applicable from the company's angle for me. I want to know the cash flows for myself. No, I cannot add 20 lakhs and then say that the company is giving me 100 lakh rupees as a free cash flow. No, because out of that 100 lakhs, 20 lakhs belongs to me. I just paid them. So that will not be considered. So understand the fact. This will not be considered. This will also not be considered. Yes, if there is any short-term funds belongs to the bank or some other, it will be under current liabilities. It will not be related to these. So if there is any repayment of short-term fund, it will go out. If there is an issue of short-term fund, it will be added, but not the long-term fund in FCFF. Understanding? FCFF only means before deducting or adding all these cash flows, all these interest, principal and everything. That's it. Now, one more thing. It is very easy if you start with EBIT 1 minus tax, because you are starting with the earnings of those people for whom you are calculating the cash flows. But the problem comes if you start with, let's say for example, EAT. What are the adjustment that has to be done if you start with EAT? It's very simple, sir. Let me tell you one thing. First of all, this will not be considered. Okay. The process from this point to this point, addition of the depreciation, deduction of the capex, and deduction of increase in working capital will remain same. The only thing that you have to consider is you have to convert this EAT into EBIT 1 minus tax and do all the adjustments here. So if you are taking earning after tax for equity shareholders, see, now if you want to start from this point, our purpose should be EBIT 1 minus tax. So you have to go all the way to that point. Now what will happen? Add back preference dividend because it has been deducted. add back preference dividend. Okay, then add back tax amount, add back interest amount. You will arrive at EBIT and then deduct 1 minus tax from that. So you can clearly do it like this: add back preference dividend, add back tax, add back interest, and then do the 1 minus tax. This is EBIT 1 minus tax itself. Okay, if you are starting with let's say EBITDA, what will happen? If you are starting with EBITDA, the ultimate purpose is to convert it into EBIT 1 minus tax. So first of all, do it 1 minus tax. If you have the depreciation, you can deduct the depreciation. You can do it like this: deduct the depreciation. This is EBIT, then 1 minus tax. This can also be done. Okay. And let's say, for example, if you start with FCFE, now what you will do? If you have FCFE and you want to go to FCFF, please understand, you will have to adjust all these things, because in FCFF we do not add new funds, right? So deduct it. In FCFF we do not deduct principal repayment, reverse it. In order to reverse these two things, we will change the signs. So new funds will be deducted, principal repayments will be added, like this. FCFE. If you start with FCFE, have a look. FCFE, okay, free cash flows to equity. You deducted interest earlier. You will add back tax saving on interest. You will add back tax saving on interest. 1 minus tax interest, after tax interest, or later on principal repaid. It's not prepaid, it's repaid. Okay, you can deduct, remove P from that. We already deducted principal amount, the repayment amount, added back, reverse it. You added the new debt issued in FCFE, reverse it. You paid the preference dividend, reverse it. All the workings should be reversed. Okay. After that, this interest 1 minus tax, what does that mean? You have to take all the interests after tax as well. Now, one thing that might come to your mind is that the tax amount differs. Vary. Like, I will tell you one thing. The tax amount, see EBIT, if we take this example, the tax amount here is 75. But if you do EBIT 1 minus tax, then it will be 105. Means 105 altogether will be the tax amount, 50%. So the tax amount won't match while calculating free cash flows to firm, because, let me tell you one thing, because free cash flows to firm means the tax amount which is payable by every other capital contributor should also be deducted, which was not deducted in the profit and loss account. Means loan for the lenders, interest is an income. They will also have to pay the cash tax to the government. That should also be deducted. Sir, why we will deduct the tax? Why we as a company will deduct the tax on interest for the lenders? Because it's not we anymore, it's the firm. So firm is looking from their angle. So if you are looking from lender's angle, I will have to pay the tax. If you are looking from the debt holder's angle, I will have to pay the tax. So tax should be deducted. Don't look it from the company's angle. Don't look at this free cash flow to from the company's angle. This should be looked after from the angle of every capital contributor. So whosoever will have to pay the tax has to be deducted. Earlier we looked into this entire situation from the angle of the equity shareholder, and equity shareholder and the company is same, right? So that's why you could clearly see that the tax given in the question, the company's tax, was deducted from the equity shareholders cash flows, because the tax was same for these people also. But now you are not the company anymore. Looking at the question, you are the lender also, you are also paying the tax. So that's not a free cash flow to you, na? You will deduct that tax amount anyhow. So yes, the tax amount will change for sure. It will not be 75, it will be 105. And that's all okay. 75 is the tax amount only for the company, and your company means the equity shareholder, and you are not calculating cash flows for the equity, you are calculating cash flows for the firm. Look from their angle, their tax will also be deducted. Why deducted? Because you are calculating cash flow for them. Okay, so this is the entire situation. See, if you take EBI TDA, what you can do is you can just straight away deduct what I can say is tax from it, and then add back tax saving on depreciation. You can do it like this, or you can deduct the depreciation from EBI TDA, and the balance amount should be 1 minus tax multiplied by 1 minus tax. You will get the same answer. See, I will show you. EBI TDA is 260 and depreciation is 50, right? So 260 1 minus 0.50 plus 50 into 0.50, am I right? Tax rate. So this will be 130 and that will be, this will be 130 and this will be 25. The total will be 155. Am I right? The total will be 155. Now have a look. EBI TDA in bracket minus depreciation, and then 1 minus tax, and then add back depreciation. This will give you the same figure. 260 minus 50, 1 minus 0.50 plus 50. So that's 210 into 0.50 plus 50. That's 105 plus 50. That's 155. This is also giving you 155. This treatment was also giving you 155. You can do it as you wish, right? So this is how we should calculate the free cash flows to equity and free cash flows to firm. There are not many questions on this in chapter number 4, security valuation, but this will be very important in corporate valuation chapter. So have a look on question number 40 now. Consider the data given below and calculate FCFE and FCFF. Okay, fine. Assets for 2015 and 16 are given to you. You can clearly see that cash is there. Cash, accounts receivable, inventory, and this is total assets. 240 and 150. Then gross property, plant and equipment, fixed assets, less accumulated depreciation and total assets. So you can clearly see 300 rupees of the capex is there. 300. The capital expenditure has increased. Okay, fixed assets has increased. And accumulated depreciation is also increased. So we can just say that that is the depreciation amount, the difference between these two, which is nothing but 80 and 70, 150. So 150 is the depreciation. 300 is the gross PP. The increase in the current asset can also be seen here is instead of 240 and 150, we should take non-cash current assets and current liabilities. So this is non-cash. You need to understand this thing. We have to keep the cash account separate because we are calculating the same thing. So if you will do the total of those two, it will be like this. 90 plus 45. 90 plus 45 will be 135, and 120 plus 90 will be 210. Now you can clearly see the non-cash working current assets was 135 in 2015, and non-cash current asset is 210 in 2016. So it has increased by 65 and 10, that is 75 rupees. So increase in the non-cash current asset is 75. If you will look at the current liability side, account payable is there 60, short term debt is there. This is also related to bank. Okay, so we'll keep this. This is only non-cash current liability. So we can clearly see there is no change in the non-cash current liability. So if you want to calculate the change in non-cash working capital, it will be non-cash current assets, change in non-cash current assets minus change in non-cash current liability. There is no change in non-cash current liability. How much is the change in the non-cash current assets? 75. So the total increase in the current working capital is 75, which will be deducted because there is an increase in the working capital. Increase in the working capital means outflow of cash. That's why it will be deducted. Okay. After that, you can clearly see that there is an increase, addition of 30 of the short term debt. We will add it. We will add it while calculating FCFE. 30 rupees because it is an addition. Short term debt. Long term debt. If you will see, the long term debt is being increased. So addition of the long term debt, issue of long term debt is 42. The total debt is 72. But out of that 72, 42 is long term, 30 is short term. Keep the difference, I will explain it later. Common stock is equity, retained earning has also increased, and total liabilities and equities. Okay, this is now sales. Sales for 2016 will only be applicable, not the previous year. So sales minus cost of goods sold will give you gross profit 540, selling and administration expenses, EBI, TDA. Okay, till this point everything is right. This is also cash, but we have deducted non-cash item from the EBI, TDA, EBIT. For FCFF we can use this, right? Less interest expense, EBT, tax, net income, we can use this for FCFE, right? Anything else? We have to calculate the answer now. How to calculate the answer now? FCFE, it's very simple. FCFE is nothing but start from the earning after tax for equity, which is 168. Am I right? Plus add back depreciation, which is 150, less deduct capex. Am I right? Increase in the working capital. Am I right? Minus any repayment of the debt. Do you think there is any repayment of the debt? No, there is no repayment of the debt. We cannot see anything. In fact, there is an issue of the long term debt. We will add it. Okay. So there is no repayment of the debt. Repayment is not there. Plus issue of new debt. Is there any issue of new debt? Yes, sir. There is an issue of long-term debt and short-term debt as well. And both will be added. 72. Getting it? 42 and 72. Please understand, for equity shareholders, this will also be added and this will also be added because both of them shows cash inflow, right? But for FCFF, this will only be added, but this will not be added because we are calculating the cash flow for these guys also. 42. So you can just write down 72 minus 42, or you can just simply add 30. The net effect should be addition of 30 because now you are calculating FCFF, calculating for debt and common stock as well. Okay, so this is it. This is your answer. Have a look on this. 168 is the profit after tax. Very easy. 150 depreciation, 300 your capex, 75 is the change in the working capital. Non-cash working capital, sir. Non-cash working capital. Do not include the cash item in that. There is no repayment and there is an issue of long-term and short-term debt. Just write down 42 and 30 here. So the total capital for the cash equity is 15. Total capital left for the equity shareholder is 15. Okay, cool. But if we go and try to calculate FCFF, this is all the working that you have to show. See, this is the capex, difference between opening and closing. This is the depreciation 150 item that we just calculated. Change in the working capital, non-cash working capital, non-cash working capital, right? Then new funds issued, short term and long term, total 72. Now come to this point. If you want to calculate for FCFF, am I right that we should start from 285? Yes, sir, we should start from 285. What will be the next thing? The next thing is we will deduct the tax out of it. Then we will add back the depreciation. Am I right? Then usual capital expenditure and change in working capital. See, EBIT 1 minus tax, depreciation, capital expenditure and change in working capital. EBIT, depreciation, capital expenditure, change in working capital. If there is some misprinting here, please add short-term funds issued. I told you, short-term funds. Are you getting why we are adding short-term funds? You might think that the short-term funds that has been raised should not be added. No, it's not like that, because that 30 belongs to does not belong to the debt holder and equity shareholder. They have not contributed it. No, 42 was the only figure that was contributed by the debt holder. So we cannot consider the situation that we are taking out some money from one pocket and putting it in another pocket. So 42 is like that, but 30 is not like that. That's it. Done with this question. I think it was easy. Consider question number 41. I think 41 can be taken, but it is based on a new concept of capital asset pricing model. So I think we should postpone it. 41, 42. We will have to postpone these two questions. I am just postponing these two questions, and I will take it after reaching at a point in portfolio management chapter. So you can clearly see there is some method which has been used, RF plus beta in bracket RM minus RF. So this is a concept in portfolio management chapter. Before explaining that, it doesn't make any sense to take this question. So I'm postponing these two questions. We'll take it after the portfolio management chapter. Now the end. 43 starts with the new concept called as enterprise value. So I told you that FCFE, FCFF took 1 hour for the explanation, but there is no such questions in this chapter. The same is covered in the corporate valuation, and we will take it there. For now, I will just stop here. We'll take the break, and I will be back in the next lecture with the new concept, enterprise value. Also, this concept, enterprise value, also doesn't have many questions in this chapter. So we'll finish it as soon as possible, and then I think we are going to move over to a better concept which has many questions in this chapter, which is called as right shares. Okay, so in the next lecture we are going to start with the enterprise value concept and then right shares. See, FCFE, FCFF, then FCFE, FCFF, and Gordon's growth model. This is also based on CAPM. This is also based on capital asset pricing model. This is enterprise value, enterprise value, enterprise value. So 3 questions will be there on enterprise value, and after that we'll start with the right share. Once we start with the right share, it will keep going on till question number 55 before starting a new concept. So bye bye for now. We'll see in the next lecture.